talk macro for a moment, and this is a little bit of a pause here this morning, but we've had this big upsurge.
Yeah.
Anything, you've been pretty bullish.
I have been bullish, and that's worked, but I do think we could be due for a pause. There's an old Wall Street maxim, you've been around, sell Rosh Hashanah, buy Yom Kippur.
Right.
And more than 2/3 of the time, this last week and a half of September tends to be a weak time, on average down about 0.4% in the S&P 500, 0.5% in the Dow Jones Industrial. I think that's the bad news, Julie, so maybe a little short-term volatility.
Yeah.
The good news, you got so many tailwinds. Number one, you got consumer sentiment completely washed out at levels not seen since the COVID lows, and prior to that, the European debt crisis in 2011 and the great financial crisis in 2008. What happened 12 months later when consumer sentiment was this low and washed out? S&P was up 24.1%. The other thing you have, as we know now, is the tailwinds of the Fed cuts. And if right now, market's expecting 4 to 5 cuts over the next 12 months. In an expansion, if we don't go into recession, we're showing no signs of immediate recession. GDP is still positive. You have up 16.1% over the next 12 months. And then you got earnings accelerating. So estimates for next year, 13.7% earnings growth, up from $300 a share to $305 a share. So I think the theme is going to be pick your spots, because maybe the indices don't do quite as well prospectively as they've done in the rearview mirror the last few months, but under the surface, some tremendous opportunity.
Okay, where's the spot?
Okay, well, first thing, we've got a 4 times in a 100-year opportunity in small caps. Small caps valuation relative to large caps has only been this low. This will be the 4th time in 100 years.
Okay.
Last time was the early 2000s. Over the next 6 years, you had dramatic outperformance. Fed cuts are a huge catalyst for this because they can refinance their debt. They have faster earnings growth relative to the S&P. They have a lower multiple relative to the S&P. So I know a lot of value guys and girls have been calling for small caps for
really? I haven't noticed, Tom. I don't know what you're talking about.
But for all of our technicians out there, they're actually starting to break out. Not that the fundamentalists really care, but it's a good sign. They are starting to break out, and now we finally have that Fed.
Okay, I'm going to ask you the same thing I asked one of your peers on the street who was also talking about small caps last week. I just, for fun, went back and looked at the relative performance of small caps versus large caps.
Yes.
10-year period, 20-year period, 30-year period, 40-year period.
Yeah.
Guess what outperformed at all of those periods of time? Large caps. So is it small caps over large caps, or is it just? I mean, it's not like you're selling your large caps.
No.
You know what I mean?
It's cyclical. If you look at small cap value over the last 40 years, dramatic outperformance over large cap. It depends on the start period and the end period, particularly if you look at when periods get flushed out like this.
And I guess the sub part of small cap as well is important.
Profitable. Yeah, profitable dramatically outperforms unprofitable, and you have solvency risk obviously in some of that index. But if we look prospectively, earnings growth expected to be something like 30-35% next year relative to the S&P at 13.7. S&P trades at 22.5 times forward, which is a little bit stretched. Small caps, 18, 17, 18.
So would you buy, for example, the S&P small cap 600 over the Russell because it tends to be more profitable, or would you zero in on small cap value specifically? Like, how are you thinking about it?
Yeah, I would be focused here just because of where we are with the easing cycle. I'd be actually skewed towards value because that's where you're going to get the cyclical upturn of the acceleration that's driven by refinancing and the earnings power. The other thing is energy, by the way. You can't give away energy right now. If you believe in data centers, this is the covert AI play. You've got that sector is trading at the lowest multiple in the S&P 500, 15.2 times. It's going to have the second highest earnings growth next year at 17.7% earnings growth. So you can't,
even if oil prices remain suppressed.
Just on demand, okay. There is a case we're moving into the seasonal period where energy starts to outperform in the fourth quarter. So I think you've got to have a little. You haven't had the weight in the S&P this low in energy since the COVID lows when energy turned negative. It's only 3% of the S&P. Every time you've bought that, I mean, we were buying ExxonMobil hand over fist at $33 when oil turned negative in 2020. We see some selective opportunities in energy just like that. That doesn't preclude tech being great, consumer discretionary, but it's like, when these things, generational opportunities are served up, you got to pay attention.
Okay, and so in our last 30 seconds, an individual one of those, Jerry Jones is linked to this one, which you gotta love.
Comstock Resources, look, full transparency, we built a position at $8 and $9 a share. It went to $28. Now it's at $16. New money coming in from clients. We are putting new money to work at these levels.
So what
Why?
makes yes?
Okay, 1.1 million acres in the Haynesville, Bossian formations. This is Louisiana and Texas. It's near the export facilities. It's near the liquefaction facilities. The demand for exporting LNG is going to go up with the trade deals with Europe. The demand in the data center, a lot of data centers are being built in those areas. You're going to have 165% growth in data centers by 2030, according to Goldman Sachs. 60% of that power is going to come from natural gas.
Right.
They are the lowest cost producer. And Jerry Jones is a master. He was an oil and gas wildcatter. That's what gave him the money to buy the Cowboys. He's got 75%. He says his interest in natural gas is greater than his interest in the Cowboys.
Wow.
And so Comstock Resources is trading at $5.7 billion market cap. That's PV. That's his book value. PV10 reserves. They've got 30 years of drilling rights, which means this could be a $45 stock over the next few years.